the first to mid-quarter scale down its guidance as well as talk about furloughs in Q3. Since that happened, there was incremental selling pressure. Today we speak to Happiest Minds. The stock has seen a 35% fall so far this year. Venkatraman Narayanan, who's the Managing Director and CFO of Happiest Mind, joins us now to discuss how business is shaping up at a time when larger companies, HCL Tech, spoke to us about higher furloughs, and Accenture's implied guidance also suggested a slowdown in growth. Mr. Venkatraman, thanks a lot for joining in. There are very disparate views coming in from the IT sector. On one hand, there are people talking about clients deferring deals, perhaps delaying decision making as well. But on the other hand, some companies believe that it's really very company specific and not an industry wide slowdown. Your thoughts, and what do you see as the big triggers in 2023?
Good morning, Sonia. Thanks for having me on the show this morning. If you look at it, you should look at IT from a sectoral standpoint. So there are companies like ourselves which are focused 100% on digital capabilities, digital work. We are less likely to be affected is what we have seen until now. Maybe the traditional IT services may have a little bit of impact because of the market conditions. But overall, if you look at this quarter, which is Q3, we have lesser number of working days. And given the number of holidays, billing or in revenues tends to be slightly lower. So if you look at it on a quarter-on-quarter basis, that's the only impact that we are seeing as of now. Because of holidays and people taking accumulated leave, there could be some slight reduction in revenues. But fundamental traction in revenues, we are not seeing it as of now. The second thing, we've been talking about it in our calls earlier as well. We are looking at certain reprioritization of expenditure by our clients, but not cancellations as some of the market participants fear, which is also what I hear the large and the biggies also talking about it in a similar vein. So if you've heard results from Accenture, TCS, they're all talking about the same thing, that the fundamental spend is there. The digital work, digital transformation related work is there. It's only some bit of reprioritization that can happen going into 2023 or looking at the early economic conditions, the macroeconomic conditions.
We learn a new way to define delayed but not denied, that is reprioritization. If you could tell us a little about what sectors are facing this the most. I mean, HCL Tech had guided for higher furloughs in high tech, BFSI, telecom. Your exposure is across the board. You have education, BFSI, travel, retail, industrials, manufacturing. And when you talk about reprioritizations, the biggest risk is budget cuts coming in as well, or maybe them being delayed to a longer, for a longer period. What are the conversations that you're having? Because this usually happens in Jan-Feb, right?
Yes, that's right. So we have discussions with our clients in the months of Jan to Feb. And that's what I was mentioning. In terms of spend, we've not heard of any major cuts. There are some small reallocations being done, capital allocation being prioritized at the client's end. That's what we are seeing. EduTech as a sector, we work largely in the US, not with Indian EduTech companies. I think EduTech as a sector has been a little on the defensive while people talk about it from an Indian context, but we have largely been working with large existing companies working on their digital transformation. And that's progressing because that's the only way they are thinking of going forward. So EduTech is not a problem. High tech, I think people are taking off on the basis of, what is a shipment of Apple devices and those kind of things happening. We are not working with those large companies. But that said, if you take those as indicative kind of signals, there are some sort of supply chain issues, really not demand driven on that side. So we are also not seeing too much of, pressure on that. Retail, we did mention our presence is small, but we are seeing some bit of, I wouldn't want to say weakness, but yes, they are thinking about new projects. They are thinking of spends seriously because it's very closely linked to, the inflation and the other macroeconomic factors that one talks about. So retail, yes, some bit of, correction. BFSI, we are not working with the traditional banking sector, as you would say, which banking sector is doing pretty well. And I think from that standpoint, we are not seeing too much of weakness there as well. That's what gives us a confidence, and we are holding on to our guidance of 25% for the current year. Only thing I highlight is Q3 can be a little bit of a dampener on revenue, because we have shown 10 quarters of 5% plus sequential growth in dollar terms. You could see some small correction for the holidays and the leaves that we are seeing in this quarter. Otherwise, there is no other fundamental change we have seen or we have talked about until now.
Right. Venkat, would margins also, I don't know if you've put out a guidance though for margins, could there be any downward bias for margins?
We have our guidance at 22 to 24% in terms of EBITDA. Happy to say that we have beaten that in 10 quarters, and we've been doing 25, 26%. And as of now, we are holding on to that kind of a range. Don't see any major concerns. It could be some small little correction because of, the leaves and holidays, and that gets moved to the next quarter. Some of it goes away, but most of it moves to the next quarter.
Okay. Just one more question on guidance. I know it's a far way off, but you have an aspiration of $1 billion by FY31. Given that perhaps we're heading into a recession, you think you may sort of need to tweak that a bit, or not just yet?
No, Sonia. I don't think we want to tweak that. It's a guiding, it's a vision for us to touch that $1 billion by 2031. And if you look at it, growth of about 21% CAGR over the next years should take us to that number. We are currently comfortable at about 25%. So that does take into account some of the bad years, 2023, if you look at it. But, it's a long-term vision of the company, and we are working towards that.
Right. Just a couple of data points, if you could help us with, Mr. Venkataraman. The first one is, what is your dependence on short-term deals versus long-term deals? Because in near-term, uncertainty, short-term deals get impacted the most. That's one. And second, you said decline in attrition is likely to continue into 2023. It was close to around 23, 24% in the first half of this year. How much better is it likely to be?
Yeah, we are seeing decline in attrition. So right now, we're just about to declare our results, and we would give you the numbers, but we were at about 24%. It's the trend on that one is declining. So we were at 23 kind of a number when I last checked it, and it's going down. So that's on the attrition. With respect to short-term deals versus long-term, we don't look at it from a deal standpoint. We look at our strength of relationship with the customers. So there's a data point that I typically share. 50% of our business comes from customers who've been with us for more than 5 years. That doesn't mean that the others have been lesser or far lesser, but the strength of the business is the relationship that we have built with our customers. And 90% plus of our business comes from repeat business. So these two show that it's essentially the relationship that you build with customers that matter.
Okay, obviously. For any business, I guess that's the case, right? Thanks a lot, Mr. Venkataraman. Have a great year ahead, and we will, of course, touch base with you again in a few weeks from now, post the results. Thanks for joining.
Happy holidays.
Happy holidays to you too. Well, that's Happiest Mind speaking about how they still have that $1 billion target by FY31. There's no reason to tweak that. And even in the near term, they're holding on to their margin guidance of 22 to 24% and also holding on to their FY23 revenue guidance of 25%. For the market, it's still where we were at, which is absolutely